What's going on, guys? This is Lior, and welcome back to my channel. Now, what I thought I would do in this video, guys, as you can see, I've got an Excel sheet up. I'm going to go over just how the numbers on a lot of multifamily look around Boston today, around the Boston area. So whether you're, a house hacker, someone that's looking to use a low down payment loan on a multifamily, or someone that you're, someone that's an investor looking to put 25-30% down and go buy a multifamily. I'm gonna show you guys how the math, and actually I'm gonna make the sheet bigger. I'm gonna show you guys how the math looks like today with the higher interest rates. So you guys get a feeling of what the numbers you would be playing with if you wanted to go and invest in real estate today. I am still buying property today. I buy larger buildings, but I still think there's a lot of great opportunity in the small multifamily space. So with that, let's go right into it. So as you can see, guys, this is my Excel template. If you guys haven't received a copy from this, make sure you reach out. I'll send it to you for free. No big deal at all. But here's kind of how numbers look. So real quick, in terms of the sheet, the way I look at numbers is base case and high case, or for multifamily, what we typically do is as is case, right? And this will be edited, and then stabilize, right? Because with multifamily, a lot of times we have tenants that are paying, below market rents, and you'll have to buy the property potentially with those tenants, maybe do some upgrades, maybe not, and then rent out for the full market value, right? So we want to see what the numbers look like as is. And then what they will look like stabilized, right? Again, very, very common with multifamily, especially around the Boston area. So let's go right into it. So cells with yellow are cells that we're going to input assumptions for. So, we start pretty straightforward with purchase price. Closing costs, I usually do about 1.5% or so of the total price. Now, repairs, if we're going to do repairs, maybe we won't. Let's just put them for 0 for now. That's just going to impact your cash out of pocket and your cash on cash return. Let's say we've got a pretty clean building. Maybe we're just inheriting a building, it's 3 units, and maybe, the tenants are paying a little bit below market rent, right? Now, down payment, again, if you're a house hacker, you're going to put 10% down for this, or 5% down if you're using like an FHA loan. If you're someone that's, an investor, again, you're going to be putting down 25 to 30%. Interest rates today, we can probably get around 7, low 7s. If you're using an ARM product, so if you don't know what that means, talk to me about that. I've got some great lenders around the area that can do some more creative products that can help you beat down the rates. Now, let's look at a typical 3-family. If it's 1.1 million, we might be looking at areas like Dorchester, Everett, Malden, Revere, areas like that, right? So let's say we got 3-unit building. Let's say it's all 3 bedrooms, and today's rents are all $2,400, right? So that's the as is. Now, we know that potentially once we can get up to $3,000 per unit, because that would be market value, for example, for a 3-bed unit. So we're going to input $3,000. If it was like a 2-bed, 3-bed, maybe we do like $2,700, right? But, so it just depends on the building. But you guys can obviously adjust those as needed. We'll put that back here for now. So that's really all you have to do for your income side. If you don't know what the rents are going to be like on the back end, or what they should be, talk to me. I know these rents around the area super, super well. Operating expenses, this is going to be relatively straightforward. You're going to want a repairs and maintenance budget. You're going to want a vacancy budget. Water and sewer depends on the type of building and how many bedrooms there are and how many units there are. Typically, I would say it's around $100 per unit. If you're buying like a building with all 4-bed units, maybe you bump that up to 125, 150 per unit. If it's a 2-family with like a 2-bed units, maybe you only need 70, 80 per unit. I'm going to use $100 per unit per month here for this 3-family. Again, you can use more. Common utilities, typically you're going to be only paying common electric. It's pretty dirt cheap, 60, 70 bucks at most. Other, this could be things like snow, landscaping, if you're going to do any sort of pest work. Again, this will depend on the size of the building. If it's a larger 3-family, maybe we go $250 per month. Oh, not $2,500. 200. Whoops. 250. Oh, still there. Come on. $250 per month. We can do that on both cases. Again, if it's a two-family, maybe you do 175, 200. It's really just snow. Landscaping is probably going to be the biggest thing. And then insurance and taxes. Insurance, again, depends on the building. For a three-family today, you're actually probably looking at $400 per month, maybe even a little bit more, just depending on the area. And then taxes, pretty straightforward. You just get that from assessment data. If you guys don't know where to find that, ping me. But we can get that info pretty quick. And that's all really we have to fill out, right? So now what you'll see is the way this will pencil out is we're going to calculate our monthly net operating income. By the way, this 29% here is the percentage of the total operating expenses to the total income. For most multifamilies, I'd say you want to be around 30 to 33, 34%. That's about right or so. So this is right around, makes sense. So you basically, it's a gut check to make sure we're in line. Now, debt calculation, so mortgage, you're going to have your mortgage payment. If you guys are using an FH, a low down payment loan, like a 5% or 10% down, you're going to want to make sure to include some sort of PMI here. So this cell should actually be in yellow. I apologize about that. Let's do that right now so I don't forget. So if you've got, like I said, if you've got an FHA or 5-10% down, low down payment loan, you're going to be hit with PMI. Let's leave that out for now. Boom, 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 boom. And now you can kind of see cash flows per month. Obviously, again, with as-is rents, it's going to be, because we're collecting low rents, it's not going to be great. But if we can stabilize them, you can see we have quite a bit of swing. Cash on cash return is about 3.5%. Not too bad. It's not amazing, but for being around Boston for the high interest rate environment we're in, that's actually kind of standard of what we're looking at. Now, some other things you want to be accounting for, some other metrics potentially, depending on how you analyze your deals. IRR is always a good metric to look at, based on a 7-year ownership schedule. So this will pencil out the number for you. We also have equity multiple, gross return on investment, and an average annual return. Again, you can see that you do really well on these, right? I mean, you're basically collecting 225% on your money. Average annual return, you're collecting over 30% on average annually. Most of the other assumption here is annual appreciation rate, how much your building grows by. If you want to be super, super conservative, maybe you do like 2% or 1% if you think there's going to be no growth. I typically opt for 2 to 3%, I think is fair number. That's pretty low. It's well below inflation today. And the other thing I look to is like the stabilized cap rate, right? I mean, even if it's a 2 or 3 unit building, again, just to kind of get a sense of like where your stabilized cap rate is once you do any sort of renovation or stabilization work, it's good to see that. So, something like this is pretty typical for a 3-family. Again, with today's rates, you're probably going to be around 3-4% cash on cash, maybe even a little bit lower if it's a really good location. The reason we're paying these crazy prices, I tell everyone, is because Boston's going to be a super stable market. And we still do well. You can see that we're still returning 225% on our invested cash. We still have a great average annual return when we account for the mortgage pay down, the equity growth. Those are all really important. Now, let's say we wanted to look at a 2-family. Let's say we're going to look at like an $850,000 2-family. You're going to see that the financials are going to be different. Let's say, again, 2 units are paying below market rents. And again, let's say we're dealing with a three bed units, right? The only thing that's going to change is water and sewer. Let's say it's going to be $200. Your taxes is going to be lower. I mean, because it's going to be it's probably going to be assessed for less. So let's say it's $6,000 per year. Your other cost is also going to be probably lower since it's a 2-family. Again, let's do that. Actually, your insurance should also be highlighted. So sorry about that, guys. Insurance is also probably going to be a little bit less because it's a 2-unit, so maybe that's 325. So we do that. Oops, we forgot to change this right here. Boom. So you can see, again, we're getting that 32% ratio, which is about right for these kinds of buildings. Now, again, what the thing you'll notice with these two families is it's harder to cash flow, right? And you're actually, in this case, you're basically getting right about into break even. So if you pick this up at, like, let's say, instead of 850, 820, for example, right? You're basically pushing right around break even, minus $70. Two families are definitely a lot harder to cash flow, no question about it. So with two families, you typically want, some sort of upside, maybe on value, maybe you're doing some sort of renovation, right? So let's say we were buying a place where we wanted to renovate it, right? We're going to put $60,000. We're buying it for $820,000. Now, the other assumption that I put in here is market value when stabilized, right? So this is basically just saying, hey, the value of the building is our purchase price plus whatever construction we put in. But let's say we're actually buying something where we're going to make some spread, right? And let's say we're buying it for $820, we put $60,000 in, but we look at the comps, and all of a sudden we know our building's actually going to be worth, instead of $880, $950, right? Because we're actually making some spread. You can see that's when you're going to start to make similar types of returns. Maybe you need a building that's worth 980, let's say, right? Just to show you guys an example. Now we're starting to get around 200% ROI, equity multiple of 2, similar average annual return. Again, the difference is you can see the cash flows are going to be much, much tighter in a two family, right? That's just the nature of buying two families. But if you're buying something that's going to need work, you put in 60,000 and you're going to make some spread. Now, all of a sudden, you can drive returns. This is actually not super crazy as we speak. I literally have someone submitting an offer with very, very similar financials, actually even a little bit better, where the back end value is higher. But that's just something you want to keep in mind, right? Is if you're going to be buying a two family, maybe you do want some sort of renovation play, where the value of the property is worth more than your purchase price and construction. Now, let's look at the numbers with 10% down. Let's look at it as a three family. So let's go back to that $1.1 million, let's say triple decker we're going to look at. Boom, boom, 2,400. So if you're going to do, let's say, a low down payment loan, right, $3,000. So if we change this all back here, 300, right, we're going to do that. We're going to change this up. Again, the tax bill is probably 8,000. Insurance cost 400. So bear with me as I do this. Or fast forward on the video, whatever works better. All right, so 250. So you can see, right, for house hacking, if you're going to put 10% down, I mean, you're gonna, again, actually, we also need to put PMI here, right? So if you're doing conventional house hack, let's say it's 150, something like that. You're gonna need this buildings, you're gonna need it at a little bit of a better price, right? But let's say if you can knock it down to around, not $10 million, $1,050,000, right? You can basically get pretty close to break even. Now, a lot of these triple deckers, especially if they're 3-bedroom units, a lot of times you can actually push rents to like over 3,000. So, if we say, hey, if you're going to house hack and let's say you can really push the rents a little bit over for 3 bedrooms, you're going to be flirting with basically breaking even to maybe making a little bit of cash. Again, this is just the nature of house hacking, right? You're putting way less money down. So typically with today's rates, you are going to be flirting with that break even, maybe losing a little bit, making a little bit. Your returns are still going to be really strong because you have we're leveraging a lot, right? We're only putting 5-10% down. So your returns are still going to be really magnified because you're not putting a lot of cash into the deal. But that's kind of where we stand, right? Is on a lot of 3 families as house hackers, we could potentially push break even. If it's a nicer area, it's going to, maybe you're going to bleed a little bit. But that's just the nature of buying. That's just how Boston real estate is today, because it's expensive. And again, with the interest rates, you might even need to go a little bit higher, depending on if it's an owner occupant rate. Your rate's gonna be a little bit higher. But that's the general idea. So hopefully this video hopefully this video gave you guys a sense of how cash flows look, how they penciling out for 2-3 families around the Boston area today. Of course, guys, if you have any questions, any concerns, make sure you hit me up, and I will definitely help you out.